Well, let me at the outset thank HDFC for inviting me here today to come and talk to all of you. During the next about 30 minutes or so, I'll talk about HDFC and then leave some time for question and answers which you may want to ask. To very quickly give you a flavor, the presentation is broken up into 5 or 6 parts. First, for some of you who may not be fully aware of the company, a short snapshot on how we started and what we are doing. The second session is on the mortgage market in India. The third session is on operating and financial numbers. The fourth session is on valuation and shareholding. And then in the next session, we'll talk about some of our key subsidiaries and associate companies, where so much value has been created over the last many years. And the last section is really on financial numbers, which would be there before you and you can have a look at it. To give you a quick snapshot, we started in 1977, and the main purpose was to provide loans for the purchase of construction of houses in India. And over the years, as the financial sector in India opened up, we started looking at different business areas. So we started a bank in 1994, HDFC Bank, listed on NYSE, it's done 3 ADR issues. Market cap is about 34 billion US dollars. Then we started a life insurance company in partnership with Standard Life of UK. We own 73% of the equity in that business, doing extremely well, particularly in the current year. There was a period of 2 or 3 years when the insurance industry in India per se was slowing down, but this year we have seen huge traction and massive growth. We own 60% of India's largest asset management company, where we are currently managing about 1.4 trillion rupees of funds. We own 74% of a general insurance business, close to 60% of a housing finance company which operates primarily in smaller parts of the country, in Gujarat, in MP, in Maharashtra, in Karnataka, and a few other states. We also own 2 venture capital companies through which we raised funds both locally and from overseas, and these funds are all invested in the real estate market in India, and we get a fee and a carry for running that business. We also own 90% equity in an education finance company, which is still relatively small in size, but doing extremely well. It's got gross non-performing loan numbers of less than 10 basis points. HDFC is largely owned by foreign institutional investors, and 76% of our equity is held by foreigners, and there are close to 1,350 overseas institutional investors who hold equity in the company. So it's very widely spread. Giving you some sense of how the business has been, our total loans outstanding are close to 35 billion US dollars. Housing loans have grown at a compounded rate of about 20% a year now for the last 5 years. We have disbursed a total of, or financed a total of 4.9 million dwelling units, which are spread across 2,400 towns and cities across the country. We have over the years been extremely focused on asset quality, and we've always said that we will never sacrifice margin or asset quality for market share. And that is reflected in the fact that historically, from the time we started till now, our total loan losses, money we've had to write off, has been only 4 basis points of our disbursements. So cumulative loan losses divided by cumulative loan disbursements is only 4 basis points. We have always operated with a very low cost structure, and that is what gives us a huge competitive advantage. We operate with a cost-income ratio of 7.9%. Our total expenses, non-interest expenses, as a percentage of our total, as a percentage of our loan book, would be just about 30 basis points. Profit after tax, standalone profit grew in the last 5 years at a CAGR of 19%, and consolidated profits grew at a CAGR of 28%. This map shows you the map of India, and on the right-hand side you can see the number of offices we have across the country. We have, in addition to these offices, what we try to do is all our branches are required to identify nearby towns or cities where they see a business potential, and then on a regular basis, which could be once a week or once a fortnight, people from the branch visit this new town or city, set up an office in the business center in a hotel, meet borrowers, meet depositors, collect applications, and go back to the parent office where everything is processed. So this gives us a presence in these additional locations without incurring the costs associated with setting up an office. When we find that there is sufficient business being generated through these programs, we then convert those into brick-and-mortar offices. To give you a sense of the market scenario, Housing in India has been growing at a dramatic pace over the last several years, and there are several reasons why the growth has been so strong. So if you were to look at this slide, this shows you the affordability for housing. The yellow bars that you see on this chart show you the price of a house. This is an average price that a consumer who would have taken a loan from HDFC would have paid for his house. The red line starting from the bottom left-hand side and going up shows you the income of our customers. This is the income of a customer who took a loan in that year, the average income. And the blue line is a simple division of the total property value divided by the annual income. And that is the way we measure affordability. So if you see over the last several years, last probably 10 years or so, the cost of a house as a multiple of the annual income of our customers has been fairly stable. And this is primarily what has been driving the growth. Our headline interest rates in India, as we all know, are much higher than what they are in many other parts of the world. So a housing loan, on the face of it, interest on a housing loan would be upwards of 10%. On a 2 million rupee loan, for example, the headline interest rate is 10.15%. Well, what we need to keep in mind is the fiscal benefits that the government has provided to encourage people to buy houses. So the interest that you pay on a housing loan is tax deductible every year to the extent of 200,000 rupees. This limit was raised by this government from 150,000 rupees to 200,000 rupees. The principal repayment of a housing loan is considered as a kind of savings, and along with other avenues of savings qualifies for a deduction of up to 150,000 rupees. This limit used to be 100,000 rupees. So the limit of deduction both for interest and principal has been enhanced, interest by 50,000 rupees, principal also by 50,000 rupees, and effectively the tax benefit has therefore been enhanced by as much as 40%. So if you factor in these tax benefits, interest deduction and principal deduction, the actual effective cost of taking a loan is significantly lower than what the agreement rate is. So for a 2 million rupee loan, the effective cost to a customer is only 4.2%. Penetration levels of mortgages continue to be extremely low. The total outstanding loans in the country as a percentage of the GDP is only 9%. We compare that to the West. In the US and UK, these ratios are over 69 in the US and 81 in the UK. But if you were to get closer to town, China is 17, and most emerging markets in the Asia region would be in the 20 to 25% range. India is only 9, which means that we are so hugely underpenetrated that the expectation over the next 5 or 10 years is that outstanding housing loans will keep rising. One of the most important factors which drive growth is the demographics in India, and this is a point we've been making for a long time. We all know that 60% of India's population is below 30 years of age. Now, unlike the West, in India people do not go and buy a house when they're in the 20s. The average age of a customer when he or she first buys a house or first takes a loan is between 35 and 38. And with 60% of India's population today being below 30 years of age, all these people will in the next 1, 3, 5, 7, 10, 15 years need housing and therefore housing loans. And that has been one of the biggest growth drivers and one of the biggest reasons why we've always been telling investors our expectation is that the mortgage market will continue to grow at a compounded rate of around 15 to 20% a year with a 5 or a 10-year view. The other thing is urbanization in India is increasing. Today only 31% of the population stays in urban India. That number over time is expected to increase. The government is talking of creating these 100 smart cities. So if you were to look at the existing top 100 cities in India, they are built only on 0.24% of India's land. But they account for more than 43% of India's GDP. So if we were to create yet another 100 towns and cities, it can result in a quantum jump in the GDP numbers for the country. Now, creation of new towns and cities, creation of these smart cities will essentially mean that new businesses will move to these cities because they afford real estate prices at a lower rate. Labor may be available at a lower rate. Cost of living in these places would be a lot lower. And as job opportunities pick up in these new cities, we will see a migration of people to these new cities, and these people will need housing and therefore housing loans. So this will be one more potential area of growth. Coming to our balance sheet, 89% of our assets are in loans, 7% are investments, 4% are net current assets. But typically, Indian accounting requires us to hold investments at historical cost and not at fair value. The unrealized, unaccounted profits on unlisted investments as we speak today would be close to 500 billion rupees. So we are talking of close to 50,000 crores of unrealized gain only on listed investments. And this is not subject to tax because these investments have been held for more than 12 months and therefore are not subject to capital gains tax. In addition to the close to 50,000 crores of unrealized gain on listed investments, we also carry a huge amount of unrealized gain on unlisted investments. So if you were to look at a life insurance business, a general insurance business, or asset management business, a venture capital business, education finance business, these are all unlisted companies, but one or two of these over the next 5-10 years will get listed and we will see some value realization from these investments. This is an important slide. It shows you the split of our lending between individual loans and non-individual loans. So you will see that retail loans, which is loans given to individuals, account for 71% of our total book. This 4 or 5 years ago would have been as low as 65%. Corporate loans is currently 11%. It used to be as much as 14% in 2007, for example. Construction loans have always been in the range of 13 to 14%. They continue to be around 13%. Lease rental discounting, which used to be as much as 10%, has now come down to 5%. So I would say that the growth in the individual segment has continued to surprise us. It's been extremely strong, notwithstanding the weakness in the economy, notwithstanding the slowdown, notwithstanding anything else, the growth in the retail business has been extremely strong. But on the non-retail front, the corporate loans and the rental discounting loans, which effectively reflect the investment cycle in the economy, and because of the slowdown in the investment cycle, these two elements have been have grown at a much slower pace. Our sense now, as we talk to people in industry, and obviously we keep doing that all the time, is that a lot of people who a couple of years ago were not thinking of investing are beginning to relook at their investment plans. Personally speaking, I would be extremely surprised if 2 or 3 or 4 quarters from now we were not to see a very sharp pickup in the investment cycle and we would start seeing that companies will start investing. I'm sure in the course of these 2 days you will meet a number of companies and you will have the opportunity to talk to them, and I'm sure many of them will tell you that the investment climate is now a lot more conducive and that they are therefore looking at making investments. So coming back, I would expect that over the next 2, maybe 3 years, this ratio may change again, and the 71% portion, which is individuals, may come down a little bit, and the non-individual portion, which is 29%, may go up a little bit. This slide shows you the growth in the last 12 months. So you will see, if you see the extreme right-hand side on the first block, individual loan book increased in a 12-month basis by 23%, non-individual book increased by 11%. What is perhaps a little more relevant is to look at the second block, which is below, where you will see that if you look at the incremental growth in the loan book between March and September, 81% of the growth has come on individual loans and 19% has come on non-individual loans. And this is a big change. Of course, it's a big change compared to 2007, when this would have been 65-35, but it is also a change compared to last year. So if you look at that number, last year it was 91.9, and now it is 81.19, which means that we have started seeing some traction. It is still very early days, but we started seeing some traction, we started seeing some pickup in the non-individual lending business, but still it's a while away. We do not retain all the loans we originate, we also sell down loans, and this slide shows you the quantum of loans we sell down. If you were to look at the footnote over there, you'll see that we have 207 billion rupees of loans which have been sold by us, on which we get a weighted average return of 1.38%. So we earn income not just on loans which are appearing in the balance sheet, we also earn income on loans which we have sold and which are not appearing in the balance sheet. Certain categories of housing loans qualify as priority sector lending, and very often banks run short of meeting these priority lending targets, and at that time banks are willing to buy these loans from us. So for example, last year we sold about 13.5 billion rupees of loans to a couple of banks, and these were sold at a weighted average rate of 8.05%. The underlying rate on the loan was upwards of 10, or was close to 10.5%. So a 10.5% or a close to 10.5% loan was sold at 8.05%, we will continue to receive 10.5% from the customer. Of that 10.5%, we will retain, in this example, 2.45% as our income and pay 0.05% to whoever we have sold the loans to. So that creates a stream of income for future years. All the loans that we do are not directly to walk-in customers. Our loans are sourced through a number of distribution channels. So HDFC Bank accounts for about 24% of the loans that we do. HDFC Sales, which is a wholly owned subsidiary of ours, accounts for about 49% of the loans that we do. Other direct sales agents, which would include banks like Ratnakar Bank, it would include IndusInd Bank, Sundaram Finance, and a few other finance companies. They account for 18% of the business we do, and walk-in customers account for 9%. It's important to understand here that in every single loan that we do, whether it is given to someone whose loan has been sourced through HDFC Bank or HDFC Sales or any other distribution partner, the credit appraisal, the legal appraisal, the technical appraisal, the decision on whether to lend money to a particular customer or not, the decision on when to disperse money, how much money to disperse, all that is done by our own people. So in terms of quality, the quality of the loan will be the same, whether it's given to someone who's walked into our office or someone who's come through one of these distribution channels. So credit quality is totally under our control. The second point I'd like to make is that these agents are paid a commission or a fee for getting business for us, and we charge that entire commission or fee to our P&L account in the first day itself. We do not advertise that over the life of the loan. And therefore, effectively what happens, and this is very important to understand, is that at the time when we grant a loan, we would have paid a commission to the agent. So let's say the commission to HDFC Bank is 1.1%. So that 1.1% is debited upfront to the P&L account. There is a service tax of 10 basis points which is payable. So 1.2% is debited upfront to the P&L account. And Indian accounting rules, or rather the regulatory rules, require us to debit P&L account by 40 basis points, which is the provisioning for standard assets, which of course is also debited upfront. So on the day the loan is first disbursed to a customer, 1.6% of that loan gets debited to the P&L account on day one. The spread that we earn on individual loans, if you have a copy of the presentation, it's on page 24, the spread that we earn on individual loans is 1.97%, but 1.97% is earned over 12 months. So if you take that on a monthly basis, effectively we are earning 16 basis points a month, which is 1.97 divided by 12. So now if you work out the arithmetic from an accounting standpoint, P&L is debited by 1.6% on day one and gets credited by a net of 16 basis points every month thereafter. Which means that for 10 months, the loan actually creates accounting losses. Forget about generating profits, it actually creates accounting losses. So in other words, if we had done no lending in the last 10 months, accounting profits would be higher. Just a quick profile of loans. Average loan size is 23 lakhs, that's 2.31 million rupees, about 38,000 US dollars. Average loan to value ratio origination is 65%, average term is 13 years, but average duration is only 5.5 years. The reason the duration on housing loans is so very short is for two reasons. One is all loans are amortizing loans. The moment an individual gets a check for a loan, the next month he starts paying an installment, and that installment has got a principal component. So with every passing month, the principal outstanding of the loan will keep declining. This is one reason. The second reason is that the average Indian is extremely debt averse. People like to come early and prepay their loans. And we found historically that irrespective of the interest rate cycle, irrespective of whether there is prepayment charge or no prepayment charge, anything between 12 to 14% of our loans outstanding at the beginning of the year tend to get prepaid during the year. And because of the amortization and because of the prepayments, the actual duration of our individuals' loans, as I said earlier, is between 5 and 5.5 years. Asset quality is extremely critical for us. We have always told our investors, those of you who met us over the last 20 years would know that we've said that we will never sacrifice margin or asset quality for market share. So we've never sort of been excited by market share. This is reflected in the fact that historically over the last 35 plus years, our total loan losses have been only 4 basis points of our cumulative disbursements. Our gross non-performing loan number in September stood at 69 basis points compared to 79 basis points a year ago, but this is gross, it is fully provided for. Our total provision stands at 93 basis points, so against non-performing loans of 69 basis points, provisioning stands at 93 basis points. We carry an excess provision of 4.36 billion rupees, in excess of what we are required to provide under regulation. If we break the non-performing loan number between individuals and non-individuals, individual non-performing loan number stands at 53 basis points and non-individual non-performing loan number stands at 1.02%. The individual number is very predictable, it keeps on declining all the time. The non-individual number sometimes tends to be a little unpredictable. Last year, for example, at this time, this was 1.38%, and in March, this number was 1.01%. Coming to liabilities, 82% of our funding is borrowings, and then we have other liabilities of 5% and shareholders' funds of 13%. We have always kept an extremely flexible approach to funding. We have always told our investors that we keep shifting our funding sources from wholesale to retail and back to wholesale, depending on where interest rates are in the system. So if you were to look at the funding, and this is incremental funding, which is more important than the balance sheet numbers, you will see that in the first 6 months of this year, 45% of our funding, of our incremental funding, has come through deposits. And 55% of our incremental funding has come through other wholesale sources like term loans and debentures. Term loans is something which we use as a stopgap arrangement. So in periods of time when interest rates are high and we believe that rates are going to come down, at that point of time we borrow money through term loans with a condition in the borrowing that we have the option to go and prepay that borrowing if interest rates were to come down. These term loans, many of these term loans are from banks, and these term loans would therefore be at the base rate of the bank, and base rate being high effectively means that this turns out to be a higher cost funding for us. Debentures are raised from a whole variety of entities, which would range from banks to mutual funds to insurance companies to pension funds, and a whole variety of them. And deposits would largely be from public, but there would also be some corporate deposits in that. We try to match out our assets and liabilities and minimize any mismatch. So this chart shows you the maturity profile of assets and liabilities broken up into 1 year, 2 to 5, and over 5 years, and you see that we really do not take too much of a mismatch. This is an important slide, so I'll spend a minute or two on that. If you were to look at our spreads, this slide only shows you the numbers for the last 4 years. So you'll see that our spreads have ranged in this period of 4 years between 2.27% to 2.30%. So that's a very narrow band of 3 basis points within which spreads have moved. But if you were to look at the last 10 years, and you can get that data by looking at different years' presentation, investor presentations on the website, you will see that the lowest level of spreads we've had in the last 10 years has been 2.20%. The highest level of spreads we've had has been 2.35%. So we manage our spreads in a fairly narrow band between 2.2 and 2.35%. The reason we are able to manage our spreads in this narrow band is because we do not take mismatches. We give fixed rate loans out of fixed rate borrowings, floating rate loans out of floating rate borrowings, and as you saw in the earlier slide, on a maturity basis, we do not take any mismatch. Now, whilst the overall spreads stand at 2.29%, if we were to break down the spreads between retail and non-retail, individual spreads at the moment stand at 1.97%, and non-individual spreads stand at 2.97%. So the gap typically between individuals and non-individuals normally is around 100 basis points. Individual spreads, therefore, are lower. From an accounting standpoint, individual loans generate lower accounting profits. But if you were to look at it on a return on equity basis, and ultimately as investors, all of us need to look at returns on an ROE basis and not on an accounting profit basis. Our sense is that the return on equity we generate in both segments of the business is the same. Non-individual loans carry a higher risk weight compared to individual loans. Non-individual loans require a higher amount of capital being deployed into doing those loans than individual loans. Non-individual loans carry a higher requirement to make provisions, so standard asset provision is higher, 75 to 100 basis points versus 40 for individuals. And fourthly and lastly, if you look at asset quality, non-individual loans to non-performing loan, you saw in the slide on page 19, is 1.02% versus 53 basis points for individuals. So if you adjust for capital, if you adjust for asset quality, if you adjust for provisioning, the effective return on equity in both segments of the business would be the same. Strength emanates from a low loan-to-value ratio, efficient recovery mechanism, steady level of prepayments, strong brand, very large customer base of 4.9 million within HDFC, and if you were to look at the entire group, the customer base would be huge, would be massive. Stable experience management, very low staff attrition rates of less than 3 to 4% a year now consistently for the last many years. High service standards, and there are internal control mechanisms in place to ensure that these service standards are met all the time. And as I mentioned earlier, a low cost structure, which is reflected in this slide. This is our biggest competitive advantage versus the banks. So in 1990, for example, we had 727 employees in the whole of HDFC, and in 2014, we are 1,956 employees. In that period of time, our assets per employee have grown from $500,000 US to $18.5 million US. Our profit per employee has grown from $8,000 US to $462,000 US, and consequent to the growth in profits, growth in assets, and relatively lower growth in employees, the expense to asset ratio has declined from 76 to 30 basis points, and the cost income ratio from 30.9 to 7.9%. If we were to look at some financial numbers, our pre-tax and post-tax return on assets has been fairly stable at around 3.8 and 2.8%. Return on equity has came down last year, but that is because of conversion of warrants which happened in the previous year. The conversion of warrants happened because of subscription to shares of HDFC Bank, and our expectation is that going forward, the return on equity will keep rising. Capital adequacy on a total basis stands at 17.9%, of which Tier 1 stands at 15.7%. Now you may ask me that why do we need to carry so much capital? And the reason we do that is because of the fact that today our investment in all our subsidiaries are reduced from Tier 1 capital in accordance with what would be required whenever Basel III becomes applicable to us. But the investment in HDFC Bank today is only treated as a 100% risk-weighted asset because it is not a subsidiary, it's an associate company. But under Basel III, even the investment in the bank would need to be reduced from Tier 1 capital, and accordingly, if you see the footnote over there, we've given a footnote which shows what the capital adequacy number would look like if the investment in the bank was reduced from Tier 1 capital and not just treated as a 100% risk-weighted asset. So you see that 15.3% would be the capital adequacy in that instance. I don't want to get much into valuation, but if you were to look at valuation, our market cap is today about $27 billion US. If you look at our book value per share, we are significantly underreporting the book value on the Indian GAAP because all our investments are held in the balance sheet at historical cost. I mentioned earlier that the unrealized gain on our listed investments as we speak today is close to 500 billion rupees as compared to the 458 billion it stood on 30th September. So if you were to adjust for the unrealized gain on our listed investments, the adjusted book value figure would increase from 196 to 489 rupees a share, and then the price to book would be 2.1 times. And if we further adjust for the unlisted investments or the unrealized gain on unlisted investments, the price to book multiple would be significantly below 2 times book. The other way to look at valuation is to take the unrealized gain on our investments, both listed, unlisted, net of tax, reduce that from the market capitalization, and then divide that by the shareholders' funds. If you were to do that, then the price to book would be about 2.7 to 2.8 times. Shareholding, we are largely owned by foreign institutional investors, as I mentioned earlier, and 76% of our shares are held by foreigners, but these are very widely distributed over more than 1,350 institutional shareholders. I don't want to spend too much time talking on the bank because it's a listed entity and there is enough research which is done on the bank. Excepting to explain that we have a mortgage sharing arrangement which works like this, and the bank sources loans for us. They bring these loans to our office. We do the credit, legal, technical checks. We decide whether to lend money to a particular customer. If we decide to lend money, we disperse the loan, and then the agreement we have with the bank is they have a right if they wish to buy a certain percentage of these loans. I'll talk a little more about the life insurance business because it's an unlisted company and therefore there is relatively less research on that. So as I mentioned in the beginning, the last couple of years have, not this year, but the 2 or 3 years prior to that, had seen a slowdown in the insurance business for the country as a whole. This year, however, we have seen a sharp pickup. Premium growth in the first 6 months of this year was, this is total premium, including renewal premium. Premium growth was 21%. New business premium growth was 37%. Conservation ratio was very high at 92%, which reflects very high persistency. But obviously, that is something which will correct over a period of time, and we would expect that to stabilize at a little under 80%. Operating expenses have been continuously declining, and operating expenses as a percentage of premium now stand at 10.9%. Because of the sharp growth in the premium income in the current year, accounting profits have grown at a lower pace. So whilst new business premium has grown at 37%, accounting profits have grown by 7%. The reason that happens is because of the way accounting is done in India, where the IRD, the insurance regulator, requires all insurance companies to charge the commission that is paid to agents for getting business directly to the P&L account in the first year and not amortize that over the life of the policy as you would do either under US GAAP or under IFRS. Our market share in terms of private companies stood at about 15.9%. Our post-cost overrun margin in March stood at 16.1%, and our embedded value stood at about 78 billion rupees. Asset management has done very well again in this current year. Our total funds under management have now grown to 1.40 trillion rupees. We have the growth on a YTD basis is about 27.6%, but equity portion has grown as much as 44%. Market share on total funds under management stand at about 13.4%, but market share on the equity book is higher at around 21%. And equities now account for 41% of the total funds under management. Then we have a general insurance company where we have Ergo, which is a wholly owned subsidiary of Mistry as a partner. This company in the last 3 years has done particularly well, but this year, because of the fact that there have been a couple of natural calamities in India, floods in South, floods in Jammu and Kashmir, the combined ratio this year in the first half has been higher at 105%, as compared to combined ratios of below 100% for the last 3 or 4 years. Our sense is that this is a one-time effect, and next year we should start seeing the combined ratio come down again. Gru is a housing finance subsidiary which largely operates in some other parts of the country, caters to self-employed people or generally people who HDFC would generally not lend to. So it operates in a very niche market, in a very different market from what we do. The biggest strength is that their persistency in terms of growth, so they've been growing at around 25% a year after year. And more importantly is in terms of asset quality. So they manage the portfolio extremely well. The gross non-performing loan stands at just about 38 basis points. Profits grew by 25% and the market cap is about $1.13 billion US. Property funds, well, these are relatively small in size. We manage about $1.5 billion US of funds under management. These funds have been raised both locally and overseas from a whole host of investors and are invested in the real estate market in India. We get a fee and a carry for making those investments. Credila is our education finance arm, very small at the moment. Cumulative disbursements are just about 19 billion rupees. Loans outstanding are about 15 billion rupees, but growing rapidly. Growth last year was 46%. Again, the biggest strength of this company is their management, the fact that they manage their portfolio extraordinarily well, and the gross non-performing loan number stands at only 7 basis points, obviously fully provided for. So these are just some of these slides. There is a whole section on financials, which I'll probably skip, because you can always have a look at these numbers and ask me any questions you want.
Just to throw the floor open, let me ask a very quick question on a broad macro level. So we have seen credit as a percent of GDP grow to about 55%. So how do you think this is expected to pan out over the next 6 to 7 years?
Credit growth.
Yeah.
Credit growth in what? In mortgages or in the system?
In the total system.
See, the last 3 years have, unfortunately for India, been a period of significant slowdown, partly contributed by the fact that the government itself was spending less money for development expenses. and also partly because the investment cycle in India, for a variety of reasons which we all know, has slowed down a lot. Our sense when we talk to people today, and I'm talking of people in industry, and as I said in my presentation that you will over the next 2 days meet people in industry and you should directly talk to them. Our sense is that people who are not looking to invest a couple of years ago are keen to invest now. They now see the opportunity which is there, and therefore it's only a matter of time in my view before the investment cycle starts picking up. It's not going to be interest rate dependent. A lot of people talk about interest rates influencing the investment decision. Yes, it is an important criteria, but it is certainly not the only criteria. We are fortunately in a position in India which is to some extent touchwood enviable. Enviable in the sense that we've had 3 years of high interest rates, high inflation, and now we've come out of all of that. Inflation numbers are coming down, partly because of the RBI's aggressive fight against inflation over these last 3 years by keeping rates high despite all the opposition both from industry and government. And also partly because of the fact that global commodity prices are coming down, oil prices are down to significantly lower levels than what one would have expected a year or two ago. So therefore, all in all, the external environment is very conducive for growth, for reduction in inflation, and therefore, I personally would be surprised if a year from now, if we were to sit and talk, interest rates were where they are today. I would expect rates to be at least 50 to 100 pips lower. So I would sense that all these, but having said that, I still think RBI may wait, will not cut rates in December, and probably would start looking at cutting rates only in 2015. That's my personal view. So I think the environment is very conducive for growth. India is a domestic economy, 72% of the economy is domestic. So long as the investment cycle can start picking up, it will create jobs. As it creates jobs, it will increase consumption, and consumption will mean more demand. More demand means more people will want to manufacture more. So the cycle can keep rolling on itself. All we need to do is get that initial investment phase in motion.
In one of the slides, you showed the affordability index to be kind of relatively stable over the past 5-7 years. But overall residential property prices continue to rise. Right? I'm not so sure if income is keeping pace with that. How do you see that panning out over the next 5-7 years? In your view, how does it look like?
See, this is actual data from our office. So yes, property prices, if you see that yellow chart over there, the yellow bars over there, you will see that property prices have been rising on an all-India basis. But India is again a very large country. So there are pockets in the country where price rise has been faster, there are pockets in the country where price rise is lower, and there are pockets in the country where price rise has been stable, where there's been no price rise. But what you need to, when you talk of affordability, affordability is not only property prices. It's property prices and income. You need to take income into account. So property prices have risen, but so have income levels risen. And therefore the affordability ratio has remained the same. So if you see here, in 2014, this number stood at 4.6 times. In 2013, it was 4.7 times. And in 2012, it was again 4.6 times. It has moved up a little bit compared to 4.3% that we had in 2004, but broadly it's been in that range. It's impossible to talk of whether property prices will rise or not rise and how much they will rise, because India, as I said earlier, India is such a large country that in different parts of the country, the numbers may be very different. Somewhere it may grow higher, somewhere it may grow a little lower. But there are reasons why property prices are high. Take Mumbai, for example. Mumbai property prices are completely unaffordable. We all know that. The reason prices are unaffordable is because Mumbai is an island city. So there is no land. I mean, there is very limited amount of land where you can construct. So everything is constructed in the northern part of the city. So Mumbai keeps growing only in one part, which is the north. Whereas if you look at Delhi, Delhi is growing on all 4 parts because Delhi can grow north, south, east, west. So these are the constraints Bombay has, and therefore Bombay's property prices will always be much higher than property prices elsewhere. But when we talk of Bombay, property prices in Mumbai can range from 3,000 rupees a square foot if you go to Boisar, or something like that, or to as much as maybe 250,000 rupees a square foot if you want the best of the best properties in Malabar or in South Mumbai. So property prices can be, the range can be massive. What the demand is for the middle income properties, the demand is not that much for the high end properties. The high-end properties is what the media writes about because we sensationalize these things. That is what the analysts write about. But in reality, what counts is the middle-income property, middle-income housing, which is typically property prices in the range of around 10,000 rupees to about 15 to 20,000 rupees a square foot, which is still high, but still in the Mumbai context, it is manageable.
Good morning, sir. So from a policy standpoint, any significant moves you see the government making to push through housing in the construction sector? Or is there a requirement for the same in the first place?
I think the government is doing a fair bit. If you look at the time the government came in May till now, the interest benefit, the interest deduction benefit on housing loans, which used to be 150,000 rupees, has been raised to 200,000 rupees. The principal repayment of a housing loan is considered as a kind of savings. Along with other avenues of savings is entitled to a deduction. That deduction used to be 100,000 rupees, has been raised to 150,000 rupees. So overall the deduction increases 50,000 in interest, 50,000 in principal on an earlier base of 150 plus 100, which is 250,000. So 100,000 over 250,000 is 40%. So we've seen a 40% increase in the tax benefit. Now, I think that reflects the government's commitment to create housing. That's one. Second is the creation of these new smart cities. As I mentioned earlier, property prices in the major cities has become very high. Now, if we were to create more towns and cities, if we were to create 100 more cities, then one, you can see a quantum leap in GDP numbers. Just to recap the number I mentioned, I said that today if we look at the top 100 cities in India, they are only built on 0.24% of India's land, but they account for 43% of India's GDP. So if we create yet another 100 smart cities, then you can, one, see a quantum leap in the GDP numbers, that's one. And number two, what you would also see is you will see new industries migrating or starting in these new cities because real estate prices will be a lot lower over there. And if industry moves over there, if new industry moves over there, then obviously job opportunities will get created. As job opportunities get created, people will migrate, people will move to these new cities because they will probably be able to offer housing at much lower rates, better quality of life, and then these cities can grow and therefore create more GDP. So I think the government's doing its bit. We have to understand that the amount of investment that is required in the infrastructure needs of this country are tremendous, and it is going to take a little while, but the government is at it.
So I guess if there are no further questions, we can.
Thank you very much.
Thank you.